Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
All right, everybody, thank you so much for tuning in to today's podcast, or I should call it a solo cast. We're not interviewing anybody. We're just going to hand out some education, maybe some golden nuggets and secrets and tips that will help you in your financial life, in your financial planning, your retirement planning, investment management, and so on. And today we're talking about how to spot a bad financial advisor and red flags. So let's just jump right in. First and foremost, I think it's important to understand the why behind all this. Why does this matter? I think aside from the obvious, most investors, I think they assume that their advisor is on their side. And by the way, there's lots of different types of advisors out there. I mean, there's financial advisors that are true fiduciaries, NAPFA registered fee-only fiduciaries. Then there are financial advisors who are what are called hybrid advisors or hybrid brokers, where they're a financial advisor and they're a fiduciary as long as they're acting in a fiduciary capacity. And then they're also acting as a broker when they're not acting in a fiduciary capacity. So it can get a little bit confusing. And from there, then there's full-time commission-based financial advisors, which are technically called brokers. And then there's insurance agents who technically aren't regulated by the SEC or FINRA, and they have much lower regulations, and they don't have to worry about as much compliance. And that's where things get really interesting. With that being said, again, most investors, they assume their advisor is on their side, when many don't realize how advice can be shaped by incentives, let alone commissions, which has always been a big problem in the industry. Bad advice rarely looks bad at first. It typically looks convenient. It sounds good, especially if you're dealing with somebody who's a great salesperson, somebody who's really charismatic, warm, approachable. They can make something sound really great, or even a whole strategy sound wonderful, when in reality, maybe it's not the best thing for you and your family, or your business for that matter. But again, I just want to throw this out there. This stuff's not easy. And unfortunately, that's why this is so difficult. And it's also why it's so important, is because there's so much to know and there's so much out there that people don't understand. So again, that's our goal today, is to try and maybe share some secrets and get you behind the beaded curtain here and let you know what happens in the industry and how to spot red flags. So let's move into the meat of the conversation. First of all, I'm not trying to label people, professionals, as good or bad. I'm not saying anything about the people or other personalities, who they are. I'm just talking about identifying different structures, behaviors, and trying to find and discover bad advice when you're faced with it. Many financial advisors across the board, it doesn't matter what type of advisor they are. I know I mentioned the 4 different types earlier, but many of them care deeply about their clients, who they're working with, who they work for. But unfortunately, they operate within conflicted systems where it's not their fault, but it's the way that their structure is from a firm setup standpoint. So if they're not a fee-only firm, if they're not a true fiduciary, then conflicts of interest are going to arise, and that's going to make decisions tough. So I'll use 2 examples. If a financial advisor is, let's just say, come on hard times, if they're struggling financially, then obviously putting a client into an investment portfolio or strategy that pays them monthly on an annualized basis. So let's just say, we'll just use $12,000 as an example. It pays them $1,000 per month. So in other words, they'll get the full value of the work they've done 12 months from now. Or putting the client into some investment strategy or portfolio that pays them $12,000 up front, right off the bat. Then if that advisor is struggling financially, then obviously that's going to create a conflict of interest, and it's going to be a tough decision for them to make. Again, not their fault, just the situation that's at hand. On the other hand, another example would be maybe a financial advisor, insurance agent, doesn't make a difference, who isn't struggling financially, but let's just say their spouse really wants to remodel the kitchen. And that's been something they've been talking about for a long time. And let's just say you've got $1 million in your retirement portfolio, and they have a choice, again, between putting a strategy together, a portfolio together for you that is going to pay them monthly or quarterly, or pay them over time, like a retainer, so to speak, which obviously would incentivize them to talk to you more often, review your portfolio more often, or they could put your portfolio into something that pays them a big chunk of change up front, again, a commission, and let's just say that commission's 7%, or in other words, $70,000. Now all of a sudden they're a whole lot closer to getting that kitchen remodeled. So when I say that they operate within conflicted systems, there are many advisors, again, they care deeply about their clients, but it's just the conflicts of interest that reside within the industry and unfortunately how they're set up as a company. So it's not their fault. It's the industry's fault. This stuff's so confusing. And obviously that's why we're doing this podcast today and talking about the topic. Obviously a sensitive topic. The problem in our industry is the incentive-driven advice. It could be commissions. Commissions can be paid up front. Commissions can be paid. Most commissions are paid behind the scenes, behind closed doors, where you don't see the commissions the financial advisor is being paid or insurance agent. The way it works is they might charge a penalty to get out of that investment for the next 5, 7, 10, 15 years. And that's to recoup the commission they paid the advisor up front. So oftentimes, especially insurance and the insurance industry, I'll hear people say, insurance agents, they'll say, there is no fee. There is no commissions here. It's show me the fee, show me where the commission is, and they'll get all fired up about it. But obviously nobody's working for charity here. So I think transparency is much more important in situations like that. But I digress. Sales loads, this can be a commission up front, and it can be a commission on the back end. It can be trails or something in the brokerage industry where a percentage of the mutual fund expense ratios are paid to the financial advisor on an annualized basis. It could be monthly, it could be quarterly, but that's part of the investment fee that you're paying for the investment product itself. There's revenue sharing that occurs sometimes, especially when you're looking at things like 401ks. There are even situations where a financial advisor works closely with, let's just say, a CPA, and maybe the CPA shares revenue with the advisor if the advisor refers the client to that CPA, or vice versa. If the financial advisor refers the client to the CPA, then the CPA gets a piece of that revenue and vice versa. Lots of hidden fees out there, lots of conflicts of interest. These are the kind of things that we need to look out for. And then some of the conflicts of interest are not dollars and cents related. There are in almost every major brokerage firm, and these are the hybrids, the brokerage firms, not fee-only firms, not fiduciaries, true fiduciaries, but at the big, what we call wirehouses, which is where I started in my career years and years ago, there would be incentives like, for instance, they don't call them production trips anymore, but they might call them diversification trips, which obviously tries to cast the color of this is about diversification or diversifying the client, not production or producing more revenue for the company, right? But the truth is, they're looking at how can we put more clients' money into, say, put some money in bonds, individual bonds, and let's have some money in mutual funds. Let's have some money in variable annuities. Let's have some money in fixed annuities. Let's get this client some insurance. And in the absence of the conflicts of interest, none of these things are technically bad if they make sense for the client in question. The problem that I have with it is oftentimes they are positioned in a way that they're trying to make the client sticky, because there is research out there, psychological research that's been done, where the more products that a financial advisory firm or brokerage firm or insurance agency sells the client, so in other words, the more different types of products that client's invested in or pays for, the stickier that client is and the less likely they are to leave. So it not only increases lifetime value and revenue for the firm in question, but it's also going to create a sense of stickiness and loyalty, because it's a pain in the butt to move, or there's too much going on and it looks confusing. So back to that whole thing where this isn't simple, but we want it to be simple. So sometimes, I mentioned this on the last slide, but the advisor may be likable, smart, well-intentioned, but these incentives matter. Again, whether it's conflicts of interest, diversification trips, being given a all expense paid trip to go someplace because they're putting more products into the portfolio that maybe might not make sense for the client in question. So I think that the intention is there in a good way, but I think that these things generally cause problems. So if compensation changes based on what investments or insurance you buy or insurance products you buy, the advice can obviously be influenced, whether it's conscious or to the advisor in question or not. So it doesn't matter whether it's conscious. It doesn't matter whether they're thinking about it actively, or that's completely irrelevant. So moving on here, the complications with fees I don't think are ever going to go away in this industry, unfortunately. Just joking around here, I mean, tongue in cheek, if you needed a coder ring or a spreadsheet to understand the fee structure, then it's probably not the best fee structure. Some vague answers that you might get when you ask about fees, things like I mentioned earlier with insurance agents saying it's built into the product, there is no fee, or it's built in, it's in there, but don't worry about it. Anytime somebody becomes defensive, that's probably a red flag. Deflecting comments, if you're asking questions or you're talking to an advisor and they say things like, it really doesn't cost you anything, that's obviously a red flag. So if they can't explain their compensation in less than 60 seconds or hand it to you on a one-pager, it's probably not the most transparent fee structure in the world. So these are my opinions, obviously, but the fiduciary duty is what matters the most here. Many financial advisors, and honestly, if you look at the numbers, roughly 89% currently, and this is as of 2025 data, 89% of financial advisors are only fiduciaries part of the time. In other words, they only are fiduciaries when they're acting in a fiduciary capacity according to the law. So if they decide at some point they're going to talk about another investment that maybe follows a suitability standard, which just simply means that the investment is suitable at the time of sale, then at that time they're no longer acting as a fiduciary and they're supposed to disclose that. Now, I'm not sure how many do or don't, and that's irrelevant, but the point is that, again, coming back to the conflicts of interest here, some advisors, as I mentioned earlier, aren't required to abide by any SEC, so Securities Exchange Commission, or FINRA regulations at all. And these are the insurance agents of the world. They have regulations that are much, much lower, and there's much less scrutiny put on the industry as a whole when you look at the insurance world. And like I mentioned, 89% of advisors are only fiduciaries part of the time or not at all. Obviously, that means that 11%, roughly 11% is all, of financial advisors nationwide are true NAPFA registered fee-only fiduciaries. So the best place to find these fiduciaries, if you're looking to get a second opinion on your retirement plan, your financial plan, your investment portfolio, if you're looking for someone who is a true fiduciary, you've already done 90% of the research, and the best place to find them is at NAPFA.net. I know I mentioned a slide earlier. I apologize. I know a lot of people listen to this. They don't watch this podcast, or if you want to call it a vlogcast. But the website is N as in Nancy, A, P, F as in Frank, A. So NAPFA, the National Association of Personal Financial Advisors, NAPFA.net. If you go to that website, you can put your zip code in. Obviously, we would love to give you a second opinion on your retirement plan, your portfolio, your investment management. That's what we do here in our office at Libertas Wealth Management Group. But in the spirit of being unbiased, I think it's important to share this unbelievable resource with all of you who are listening or watching. At NAPFA.net, you throw your zip code in there and you can see every fee-only true fiduciary in your area. So pretty cool. All right. So product versus planning. You need to pay close attention to the order of operations whenever you're meeting with a financial advisor. So for instance, when you're talking to an advisor, how much time are they spending with you before they ask you to invest their money? Or said another way, how much time are you investing with them, or are they investing with you before they ask you to invest with them? If that makes sense? Is the conversation product first, so investment product first, buying things, investing, or is it planning first? That's another red flag. Talking about investment or insurance products before any kind of goals or background info are identified, or maybe it just seems the questions that are asked are pretty thin. Maybe not enough questions are asked. These are the kind of things you need to be thinking about. Recommending solutions before they understand your full picture and your full life and your situation. That's another red flag. Or jumping quickly, and you'll know if it's fast or too fast just by a gut feeling, but jumping too quickly into annuities or insurance or proprietary investment products that the firm sells, for instance. So good planning, financial planning, retirement planning, estate planning, tax planning, it starts with questions and planning and truly understanding the client inside and out in a very intimate fashion before anything, whereas bad planning starts with brochures and sales and products and prospectuses and things like that. So some of the trade-offs, the downsides, every good strategy has pros and cons. There's two sides to every coin. So if everything sounds perfect, then something's probably missing. Sometimes risk can be minimized by an advisory firm or an advisor or insurance agent. Maybe it's risk is glossed over, it's reframed as maybe temporary. There could be little discussion about what could go wrong or how the firm or the advisor mitigates risk. When the bottom line is transparency always includes uncomfortable truths, which are there is always a risk somewhere with something, with any investment. Even the investments that can be considered guaranteed have risks. Just because they're guaranteed doesn't mean there is no risk. That's really important. So another thing is sense of urgency. If you're ever talking to a financial advisor, insurance agent, and they get defensive when you ask a question, you might be onto something. So any kind of defensive reaction. If you're discouraged from asking questions or getting a second opinion, I might want to put my running shoes on and run as fast as possible. Any kind of pressure or sense of urgency, for instance, to act now, or discounts that are given if you commit now or make a deposit now for a discount, that's not something that I would be all that interested in if I were you. So the lesson here is confidence, and this is confidence in the advisor or the insurance agent in question. Confidence welcomes scrutiny. Like in our firm, we love questions. We always joke it's because we're so used to saying and teaching and sharing and asking the same questions over and over again. So whenever somebody has questions for us, it's so much more fun to put a monkey wrench into the whole appointment process. But again, confidence and confident advisors and professionals, they welcome scrutiny and questions. And insecurity or insecure advisors, they try to avoid it. That's just how it works. And hopefully that makes sense. When it comes down to the relationship, so the relationship you have with the advisor, it's going to feel more transactional versus consultative, long-term or ongoing. So this is something to look out for, another red flag, if it feels more transactional versus consultative. If there's limited proactive communication, that's something to look out for. If you only hear from them, if you've been working with an advisor for a long time and you only hear from them when there's something to change or something to sell, that's a problem. And then if you're doing review meetings, which, by the way, you should be doing review meetings at least, I'd say, once a year for most people. Now some folks, they feel like everything's fine. Maybe they communicate via email. Maybe they have plenty of education for things like this podcast, for instance, and they feel like they're connected enough and they know what's going on and they're not worried. Okay, maybe you don't need to come in every single year, but if you feel like you're disconnected from your financial plan, retirement plan, estate plan, your portfolio, your retirement portfolio, then you need to be meeting at least once a year, and at least just to get caught up. And then if you feel like those reviews are rushed or kind of surface level, if they happen at all, then that could be a problem. So real consultative advice is a relationship. It's not a series of transactions or something being bought or sold or changes that need to be made to your portfolio whenever a phone call is made or an email is sent. So what about good advice? I know this whole podcast has been pretty negative, right? It's been all about trying to find those red flags and trying to peer behind the scenes in this industry and look for the signs that maybe you're in bad hands. But let's talk about good advice and what that looks like. So first, clear, transparent fees explained in English. Nobody works for free. The fees are not non-existent. Somebody's getting paid. And in fact, if you've ever been to a city like Louisville, for instance, that has a lot of insurance companies, you'll notice their headquarters are some of the nicest buildings with the most marble and nicest materials you've ever seen. So clearly the insurance companies who say they're not charging fees are making money somewhere. Secondly, fiduciary alignment, and being a fiduciary all the time, not some of the time. Next, pros, cons, strengths, and weaknesses are all disclosed because they exist in every strategy, in every investment product that exists on the planet. Next, recommendations based on your ongoing situation, not what was suitable for you yesterday. A planning first mindset where advice evolves as your life changes and the plan is adjusted and reacts. Investments and insurance are the tools, not the strategy. Open dialogue, education where questions are welcomed and where you don't feel rushed or that things are being deflected. And then your advisor's goal is to help you become a better decision maker over time and become more and more comfortable with where you are today, where you want to be, and how you're going to get there. So the goal is not dependency, it's confidence and it's trust. So just a few final thoughts here before we close up. First, you don't need to fire your financial advisor tomorrow if you're maybe gotten a little bit worried based on some of the things you learned today. You don't need to panic, but you should know what questions to ask. And I think that you've probably learned enough today to know what questions you should be asking. You also deserve, this is your money, it's your life savings. You deserve clarity, alignment, and transparency when it comes to your retirement plan, your future, and your life savings. And awareness is the very first layer of protection when it comes to this stuff. So clarity today, it prevents regret tomorrow. So I'll just get the disclosures out of the way here. And if you have any questions, please feel free to reach out to me personally. As always, there are opportunities here if you have an interest in getting a second opinion on your investment management, your portfolio, your retirement plan, financial plan, estate plan, tax plan. That's what we do here at Libertas. So if you have any questions, if you have interest in a second opinion, please by all means reach out. You can contact us on the web. You can use this QR code that's in front of you if that's easier. Otherwise, there are tons and tons of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.